Hi, welcome to my channel, George Credit Recovery. Thank you. Back at it again. We're gonna go ahead and be reacting to TikTok videos about credit score advice and loan advice and anything that has to do with credit. So let's go ahead and jump into this and see how it goes. Alright, let's see. Alright, let's see. Let me actually get rid of these. Bring down. Alright, let's see here. How to get a bad auto loan. Let's start off.
So you're wondering how to get out a bad auto loan deal because you went and purchased a car when your credit was horrible and you accepted a ridiculous high APR from one of these companies above: Santander, Ally Financial, Esteer Credit Acceptance, Westlake Financial. Let's go. Okay, so you have a couple different options, but just in general, work on your credit. It's very, very important. If you're looking for a quick boost, purchase a trade line or become an authorized user on someone's credit card that has 3+ years of history, a high credit limit, and low utilization, meaning they don't use that card too much. Okay, so the first thing you can do is refinance your auto loan. I recommend you going to a credit union or a bank. Please do not refinance your auto loan with the original lender. They are going to rip you off. When you refinance your auto loan with a new lender, they will ask for a deposit anywhere from $1,000+, depending on how much you owe on the account as of right now. The second thing you could do is purchase gap insurance. If you haven't already purchased gap insurance when you purchased the car, make sure you...
Oh, Jesus. All right. A deposit. I think he's maybe referring to... if you owe more than what the card's worth, you got to bring some money in. So if you owe $10,000, but the car is only worth $8,000 based off the value that the lender's using, then yes, you would have to bring in money in order to pay it down so you can get within their LTV policy. I don't know if that's what he's meant, but in case if he wasn't clear enough, I said it. Let's continue to finish watching that video.
You get it. You can purchase gap insurance on a new or used vehicle. The loan just cannot be paid off. Now, will gap insurance cover the full amount of the car? It depends on the value of the car. But you know what you can do with gap insurance. I'm not going to say it on social media. The third thing you can do is renegotiate with the original lender. Now, certain companies have different hardships that you may qualify for, depending on financially and things globally. But make sure you find out the information. And guess what? I always work on your credit, man. Never get into a bad auto loan. So you're wondering how to get out a bad auto loan deal.
Ugh. Oh, Jesus. This is definitely a very interesting video. Okay, so he provided some good information. When it comes to your credit, the areas to check are your pay history, your overall debts that you owe, how long you've had credit. Because normally it'll take a while before, depending on where you're trying to get credit score wise, if you're definitely trying to get from like bad to like good credit score, which begins at 670, that's where also you jump into a different tier credit score. But I would definitely say jumping into 720 and above, you'll get a better you get like a better credit score. So let me show you a institution that actually says it, that shows like their ranges of their credit scores based off your interest rate based off your credit scores. So let me see here. So this is kind of going to be like kind of a guideline just to be able to like understand. But okay, so right now you have right here, so to get a 649, which these are for people that have bad credit, FYI. So essentially, if you have a 549 or less, you'll get an 18%. Anything between 550 to 599, 14.74%. If you have 600 to 639 at 10%, and then 69 to 49, you will get a 640 to 679, you'll get a 7%, and again depending on the terms, and then 680 and above you get a 6%. So this is just based off this credit union of where they'll will they'll put you based off your credit score. See, so once you start hitting into that good credit score, which normally starts at 670, but they want 680, um, that's where you will go ahead and be able to get into a better interest rate. And then again, guys, remember that to ask them which credit score they use, because not all lenders just use FICO score 8 to give you a that's the credit score that they use. There's different types of credit scores that there is. So there's one that's called, I think it's Auto Score 8. Here, I'm trying to get into it so then you can see. All right, let's see here. And then FYI, this is a client's account, not my own. Okay, so auto. So these are the two scores that they'll use. So they'll use FICO Auto Score 8 and FICO Auto Score 2. So these are going to be either one or the other or both that they'll use. And how you get to here is, so when you sign up for Experian, this is actually the paid version of Experian is what I told the client to do. What you want to do is go to credit and then go to FICO score, and then it's going to bring you to this page, which then you start scrolling all the way down, and then you're going to see the additional FICO scores for credit cards, auto, and mortgages. So for this instance, we're checking out the auto, so this is where you'll see. So it's not always going to be based off your FICO score 8. It's going to be based off these credit scores. So that's something definitely to understand when you go to reapply to get a better interest rate. What you can do, yeah. So like I said, your payment history, your credit utilization, how long you've had credit. If you had collections, that can help you. Like with Credit Karma, they'll actually tell you like if you either get a collection removed or you end up paying it, how much points they'll give you. I'll link that video right here, and you can look at it next to see where, so you can go ahead and learn about those credit tickets I did on that video. So you can do that. If there's any errors too, again, that's gonna depend on a couple different factors. So like maybe if you paid a loan on time before, or maybe you have a collection that's not yours, fighting those can help you increase your credit so you can get out of the credit score. Another thing of how you can get out of bad credit, I didn't hear him mention this, but sell the car. You can always sell the car. Like that's always an option. And then if you still want to finance a car, what you can do is, if you know you're going to get a high interest rate, what you got to do is you got to mitigate how much you're asking for, because also you'll pay a lot more in interest if you have a $20,000 car versus like a $5,000 or $7,000 cars. So with interest, or not interest, with car values slowly going down, you're definitely going to start seeing those cars decreasing. So if you are in a bad auto loan, you can always get rid of the car and just sell it and just go about it that route. Um, Let me see. What else advice would I give? Trying to get out of a bad auto loan. If someone trusts you and you trust them, and you know somebody that has a better credit score, you can always go ahead and get it refinanced together with them, and that might go ahead and help you to get you out of that bad auto loan into like a better rate, and then within like 1 year refinance it out of their name. Hence, but there's more that goes into it. But yeah, just on this credit score, if your credit score is not improving, just refinance it out of their name and voila. So yeah, so that's just a couple tips there that you can go ahead and do to do that. Let's look at a couple more. Let's say this is all right. Let's see this lady. She says she knows about credit. So
My goal in this role is to help every single person get in a vehicle. So let's look at worst case scenario. Now let's see what vehicle we can land you in with all these. Oh, this one is looking promising. Maybe the Elantra. Now, I don't do this to sound mean at all. That is not the goal here. The goal is proper expectation. When you're going into something like an auto loan, home loan, anything like that, I'd be lying if I said credit didn't matter. Now, we can work with any stage of credit. What you can always get for free is some helpful advice. If you're in a stuck situation and you're looking into getting a car, but you can't qualify right now, one, give me and my team an opportunity. We are killer with bad credit. Two, if it's not an option right now, DM me. Let me help you with some credit building services and advice. I want to see us all grow and thrive together. Have a great day. Happy holidays, guys.
Well, that was pretty entertaining there. So let's see. The only thing that's not really important is, or not important, or the most important out of what she wrote was the job. Like, you can get away with not having no credit, not having a cosigner, no down payment, but a job is very important. That's like one of the most important aspects, I think, outside of credit, because you could have a really great credit score, but if you don't got a job, we're not going to give you a loan, because the whole point is repaying back a loan. That's the whole reason why lenders exist, to lend out money. It's like you got to have a way to repay it. So obviously a job is the most important. If you don't, then also if you don't have a consigner, then that means you maybe need a higher down payment, or maybe go with a less expensive vehicle. If you don't have the best credit, there's a lot of lenders out there that that work with bad credits, and like she said, she actually has access to a lot of lenders that are bad credits. So you have anything like Santander, Westlake Financial, Prestige, Arrivo. Yeah, so it was like, she is right about managing your expectation. If you definitely, let's say if you have a job but you don't have the other three, like, you can at least then be able to know that, okay, well, don't go in for something expensive. Like, don't go in for a $20,000 car, because there are restrictions such as PTI, which is payment to income ratio. So there's a certain amount of your income that lenders don't want to exceed. So like, I'll do something really easy. So let's see, if you make $1,000 a month, and they were doing, where I worked at, they had 15% payment to income ratio. So that means your monthly payment could not exceed $150 or 150. It couldn't exceed 15%. So if you do 1,000 times 15%, you'll see that's 150. I got ahead of myself, but that's essentially how it is. And if it's 2,000, you just double that. So that stuff is very important to go ahead and know when you're going, at least in through the dealerships. When you go to banks and credit unions, they don't really use payment to income ratios, but lenders that work to dealerships, they do have payment to income ratios. So yeah, that's something to know. It was like, her advice was, it was entertaining. It wasn't really anything. It was really trying to funnel to get you to help with credit, which I could see why she would say that. She is like in a great position to be able to help you build your credit, because she works with a lender. So kudos to you. Your mom's Miata. So let's see if we find another one. All right, we'll do one more auto loan and we'll switch it up. When a customer needs a car and agrees to $800 payment on the 15K. Oh, this sounds so good.
Get what? I love you, boy, and keep God in your life, fuck nigga. Do it. Get what? I love you, boy, and keep God in your.
And you see the true nature of a dealerships, and this is true. This is very true. I don't think I've ever ran into that, because $15,000 on an $800 payment. I was like, the interest rate has to be like 40%, because that does not make sense. $800 payment on a $15,000 car. Let's see here. Let me see. I'm running it on a calculator real quick. just to see 800 payment. The only thing I can see is maybe a little shorter term. Let's see. See 20%, 0 down. No, not even at that. Pay, yeah, it has to be at least 30%. Not even at 30%, guys. We're talking about 40%. I don't know any lender that charges 40%. 50%. I think he was doing that for entertainment purposes. So if you see here, I ran the numbers. So I put like a $15,000 loan. At 3 years, 50%, you get like an 811 credit score. So like, I think he was just doing that for entertainment purposes. But the whole thing is that if you're in this situation and you really don't have a lot of options to work with, you have a better chance of getting like a $5,000 or $3,000 auto loan, honestly. And this goes to show that, you know, when you get a high interest rate, $800 credit score, that's a lot. Like, you have to be able to borrow less so you won't get screwed in your payments, because once you lose a job, like, that's a wrap for you. Like, you will not be able, it'll be now if you thought it was harder for you to qualify for a loan now after losing your job and trying to pay $800 car, imagine trying to get another loan for a car that you let maybe go bad or maybe you're past due on because you couldn't keep up with the payments. See, so those are things to think about when you're getting into these loans. But that dealership just gives, this is why I'm not a fan of dealerships, because they're always just trying to rip you off. They're trying to make the most money off of you. So this is why I never suggest going through a dealership and just go through a private party. So you can go ahead and do that. So let's see here. Let's go into some personal loans. We'll do a couple more of these videos. Let's see. Alright, let's see. Reasons why Credit Karma can be so wrong. Let's go.
So I need a $25,000 personal loan. What kind of credit score do I need to get approved?
Assuming you meet all of the other criteria, you're going to need at least a 650 credit score.
Okay, perfect. Credit Karma says I have a 680.
Houston, we have a problem.
What? I'm in Dallas.
Got him.
Your FICO score shows 580, and you were denied.
That doesn't make any sense. Why would Credit Karma show me I'm at a 680, but yet I'm at a 580?
You're probably looking at your Vantage score from something like a Credit Karma. But really what you need to be looking at is your FICO score, or what I should say is one of the many different FICO scores that we might be evaluating.
So what do I do now?
You have to make sure that when you go to qualify yourself for credit, that you're pulling an actual FICO score and not a Vantage score or any other derivation. It's important to make sure you ask your lender which FICO score they're using, because there's a variety of different FICO scores as well.
So I need a $25,000 personal.
I said that. I think I even maybe have showed it in this video. Like, see, you gotta ask the lenders what kind of credit score they pull. And again, if you're not familiar with it, let me show you again here through Experian. So Experian is a FICO score. So when you go to their website and you sign up, make sure you sign up for their premium. That's the only way you can get access to the additional credit scores. So you can then ask. So let's hop back into here again, showing it for people that maybe give me 1 minute. Never mind. I was like having a little complications getting into a client's account. So we will just go ahead and move. So like he said, I'm not the only one saying it. He's saying it. Ask about that. So the best personal loans. Let me see. The problem is when you pay off. Let's see what she's saying. This lady right here.
Taking out a loan to pay off a bunch of credit card debt at a lower interest rate is not a bad idea. The problem is when you pay off that debt, you then free up all the credit cards, leaving you with open lines of credit and a new monthly payment for your personal loan. So here's the deal. It's not a bad idea if we're being strategic, but the problem is if you're paying off credit card debt with more debt, you're just shifting one debt to another, and we didn't actually fix any of the problems that got you there in the first place. What's likely to happen next is that you then have the personal loan payment, and then you start using the credit cards again.
Yep.
Which then slowly start to add up up, and then you have the personal loan and the debt payments. You see where I'm going here? Strategically, it's not a bad idea, but is strategy really what we need to be focusing on here? I'll leave you with this. Ask yourself, what got me into this situation in the first place? What got me into credit card debt in the first place? And start there. Taking out a loan to pay off a bunch of credit card debt at a lower interest rate is not a bad idea.
That is, yeah. She hit it right in the nail. Like, if you take out debt to pay it off, unless you rip up those credit cards, most likely you have a high chance of using those credit cards again. That is crazy. So that really didn't go over that. So let's see. Get a personal loan up to $50,000 with bad credit. Let's see.
Alright, so I had a few people hit me up asking me where to go to get a personal loan, and they got bad credit. Well, I got you. And always remember, what's old to me could be new to you, and we don't talk about things we don't do.
Okay, the rented Lambo. Let's go.
Watching Funny Financial, where we talk about personal credit, business credit, and how to build financial wealth. So make sure you like, comment, and share. And don't forget to subscribe. Alright, so I'm going to give y'all 2 sites I can go to get a personal loan with bad credit. And the first site we're going to talk about is Upstart.com. A personal loan for your personal needs. Check your rate in 5 minutes. Get funded in as fast as 1 business day. 43% lower rates as compared to a credit score. Flexible loan amounts. You can get a personal loan from $1,000 to $50,000. Fixed rates and terms. Choose between personal loans in 3 or 5 year terms with fixed interest rates of 6.5% up to 35.99%. No prepayment fees. You can prepay your loan at any time with no fees or penalties. How to easily apply for a personal loan. Check your rate in minutes without affecting your credit score. It's that easy to apply. Select your desired personal loan amount and preferred loan term. 99% of personal loan funds are sent just 1 business day after signing. The next website I'm going to give you guys to go to with bad credit for a personal loan is Avant.com. Get a personal loan up to $35,000. Everyone's financial life is different. That's why we offer flexible choices, simple solutions, and friendly support to help you keep moving forward 1 step at a time. So whether you need a credit card, a loan to help cover the unexpected, or a clear answer to a difficult question, we're here to help. I really appreciate y'all for giving me feedback and commenting and asking questions about personal credit and stuff like that. And always remember, what's old to me could be new to you, and we don't talk about things we don't do.
Not surprised with the advice. He's doing a clickbait title. Get a personal loan up to $50,000 with bad credit. Most likely, if you have bad credit, the chances of you actually getting approved, even for a $50,000 credit card, is not going to be possible. Like, the biggest thing that you're going to need to drive is that you've had experience with you've had experience with high personal loans. So the thing is that normally when you have a bad credit score, it's either you have missed payments, have collections, you've racked up your credit, or you have a lot of like outstanding loans, which counts for 30% of your credit score through Experian. That stuff will bring you down. So the chances that someone else is going to give you a $50,000 loan, unless you're consolidating, unless they require for you to consolidate and pay off all the credit cards and close them down, that's the only way that honestly I can see you getting approved for a loan up to $50,000 if you have bad credit. But just, hey, giving you $50,000? No. Like, I would never give nobody that's so much into debt an additional $50,000, because most likely you're not going to qualify. Because if you have a whole bunch of debt and you have bad credit, like, your debt to income is not even going to qualify you for a payment for $50,000. So, yeah, that's the thing about this. He just provides you with the source. He doesn't provide you with how to get approved, which is the most important part. It's like, it's great you want to tell me Upstart to get me approved, but when you don't tell me how, what's the credit score they look for, what is their debt to income ratio, what is the credit history profile requirement. So like, so if I was looking at a credit score, so it would be like how recent has it been since the last time you missed a payment? Are you currently paid up to date on all your payments on your loans? How is your credit utilization? How much debt you have out there? How many inquiries you have out there? Do you have any collections? Okay, you're asking for a personal loan. Okay, what's the highest personal loan you've ever had? How have you paid for those personal loans in the past? How many have you had in the past? How many do you have open? So you see all this stuff that I'm just throwing at you that maybe feels very overwhelming. And that's like a majority of the stuff that us as underwriters have to do when we're reviewing somebody's credit application, trying to give them any sorts of loan. So think about it. If you have bad credit and you don't really have a lot of positives, like, do you think you would really get approved for $50,000? So yeah, this is very interesting mix of videos. I definitely enjoyed doing those videos on TikTok. But yeah, if you definitely learned something about credit here today, go ahead and consider subscribing. I'm dropping information and gems on a daily here with my shorts, and keep up to date with more of my advice from an underwriter's perspective. Because in case if you didn't know, I'm an underwriter. Which that means I've approved, decline, or counter loans, and I've done anything that is in the consumer world. So I'll be like a house, cars, a boat, personal loans. So I understand what it takes to get approved for these loans. So yeah, definitely stay tuned so you can go ahead and learn that, because I'm going to be dropping a lot of secret stuff, a lot of financial gurus don't know, but I do know. So see you guys next time, and watch the next video. Like, come on, watch the next video. I'll put it up here, or here, and subscribe. Alright, see you guys later. I'm out. Alright, so we're going to go ahead and watch this next video from a guy that teaches credit. He's going to show us how to get approved for a FHA mortgage loan. And again, with me underwriting those type of loans, I'm going to give you some insight and see what's the information that he's given. So let's hop right into it.
Loan is and how you can use it to get a home loan with a low credit score. Guys, stay tuned.
Skip this.
Where it allowed you to put your credit repair experience into your own hands. In today's video, I'm super excited because I have a banger. In today's video, I'm going to show you exactly how you can get an FHA loan with a low credit score. This is going to be a game changer. And today I'm super excited because I have a special guest. We have a loan officer who cares in the building. The last video that he did had such a great response. We have so many people that reached out and actually use the services, ask so many questions. So guys, thank you for that. But before we get into the video, guys, please like and subscribe to the channel. It allows us to go to a wider audience. It allows us to get pushed through the YouTube algorithm and allow us to keep these lights on. Guys, please like and subscribe to the channel. Now, let's dive straight in the meat and potatoes. Let's dive straight into the first meat and potato. I don't really want to waste any time when it comes to this particular group of funding. FHA have been a game changer since it is actually being introduced. But I'm gonna introduce my special guest today, Loan Officer Cares. Man, go ahead.
Loan Officer Cares in the building. Thank you guys very much,
sir.
I appreciate your response to the last video, all the information that we gathered. So then I'm just here again, once again, to help you guys out.
Yes, sir. For those that didn't watch the first video, tell them again who you are, where you from, and what you do. Just a quick segment.
All right, thank you so much. Loan Officer Cares. I've been in the industry for over 20 years. I'm a loan officer. You just go hashtag Loan Officer Cares on Google. You'll see a lot of information about me. I truly care about putting people in the homes and putting them in position to keep the homes because we don't want them to be house poor. And like I said, I've been licensed since 2013, and I've just been on and popping at it, and I just love what I do, and I care about the people. And we're here to make the process real simple for you.
Absolutely. Well, officer, are you working out?
We're in Cypress, Texas. We're off of House High Road in Cypress, Texas, out there. And CNT Mortgage is the company, the broker shop that I'm with. I'm Home Loan Officer Cares with CNT Mortgage, so we got the house.
Awesome. Getting into the home loan process, you definitely want to reach out to a loan officer who cares, and actually tap his DMs and see exactly how you can go into the process. It might be a lot easier than you think. So now that we got the credibility out the way, let's talk more about the home loan process as a whole. So as I talked about in the last video, it's 3 criteria off the gate for home loans, regardless of the type of home loan funding that you're looking to get into, whether it's FHA, whether it's conventional, whether it's VA, USDA. You have to have these three criteria. The first is credit, right?
Yes.
The second is the DTI, your debt to income ratio. And then you have to have a proper work history. You have to be on the job for 2 years minimum. We can definitely do different finagle of applications depending on the person and their job history, whether they're self-employed or whether they're actually working with a actual company, right? So those are the three things. Now, the debt to...
So we have to jump right off into it. Okay. So just to let you know, there's not 3 requirements. There's actually 8. It's called ATR, which is ability to repay. So us as underwriters, when we're looking at your application, these are actually guidelines from the government, or I guess from the CFPB, which is the government. Anyway, from the government, they require lenders to go ahead and go through these 8 different factors when approving someone for a loan. So the first one is going to be income and assets. So essentially what I mean by income and assets. So income portion of the first ability to repay is essentially providing a repayment for the loan, because that's the whole reason when give you a loan is you have to be able to show to repay. But that doesn't strictly mean that you have to be self-employed or use like your hourly rate that you get. If you get like bonuses, or let's say if you get like Social Security income like on the side, or let's say if you get you make money from stocks and there's enough for you to cover the mortgage payment plus all your other debts on your credit, then that is something that can also be used. Also, people that are seasonal employees or that receive unemployment benefits. So as long as you can have enough money to cover your mortgage payment and your mortgage payment and your debts reporting on your credit report, you can use that income. So it doesn't necessarily you need to, let's say if you have a job, you don't need to use that money if you don't need to, because you have other sources that can cover it. So that's the income portion of it. The asset portion of it is essentially you have to provide assets in order to back up the loan. So that can be assets like cash in the banks from either checking, a savings, a money market account, or even if it's a joint account. There are other restrictions when it comes to those that you have to provide. Let's see if you have stock portfolio like through Robinhood or Vanguard. If you provide a statement, that can go ahead and be used as assets. Your 401k can be used as assets. Bonds, so if you invest into bonds, that can also go ahead and be used as assets. And one more thing for the income portion of it, if you receive like alimony or child support and it's enough to cover the mortgage payment, that also goes ahead and qualifies. The next ability to repay is employment status. So if you are using W-2 or self-employed, essentially we have to verify to make sure again that you actually have the job or you are self-employed and receiving income. So that one is pretty much straightforward. Nothing really too much to get into it. The next is the monthly mortgage payment. So what the monthly mortgage payment is, it's pretty much qualifying you for the loan. So the amount that you're borrowing and what that payment is, we have to make sure that you qualify for the loan through that mortgage payment. So again, something very straightforward. The next thing is monthly mortgage obligation. So this is now including your taxes, your insurance, your HOA, any other different any other type of insurances that you pay for. So like in Florida, you'll pay for like hurricane and flood, or maybe in California you'll pay for earthquake. And you're just thinking, but George, didn't you just go over that in the previous one? You gotta remember the previous one about monthly mortgage payment is just the principal and the interest amount of the loan. It doesn't include your insurance and your taxes and your HOA if it's applicable. If it still doesn't make sense, please write it down below. Come on, I'm here to help you. So that's pretty much the difference that you got to know. And the next one is your current debts. So what does that mean? So that means all the monthly payments that are reporting on your credit report, all of that, you have to be able to qualify for the loan with those debts included in your debt to income. And there are other things that can be included. So another ones that will be considered into factors, that would be if you pay child support or alimony. That is another way. Let's see, if you owe back taxes, your monthly payment on that. Other loans that are not reporting on your credit report, that also qualify into that. So that's what I mean about your debts. This doesn't count your auto insurance. That doesn't need to be calculated. Your utilities, cell phone, none of that matters. Like, it's just pretty much debts reporting on your credit report, and federal debts, and then child support and alimony, and just to keep it simple. The next one is your debt to income, which is what we went ahead and just touched on. Again, there are certain criteria that are certain debt to incomes you can't exceed. So like for a conventional loan, it's 43, but I've seen some go up to 45%. And then for FHA loans, they're more in the they're more at 50%. I've seen then others go up to 55% debt to income. If you're not familiar with what debt to income is, I'll put a short here or here and watch it after this video so you can understand what debt to income is. And then the last one is your credit. Again, making sure that you have what is the word I'm looking for? Your credit is in good standing, because again, you can have bad credit in the past, but with FHA, as long as you're like in good standing, at least now, and I'll get a little bit more into that in the video if it comes up, but as long as your credit is good in your payment history and you don't have a lot of collections or charge off on loans, you'll be okay. So we have to take account into the credit history when we're doing that. So those are the 8 that that are required when it comes to getting a mortgage. So not 3. We're already starting off bad, but it is what it is. Let's get back into it. All
right. Income ratio for the FHA process is what?
Around 55%.
I also forgot to talk about, so he talked about employment and how you have to prove 2 years of history. When you're going through 2 years of employment history, this doesn't mean that, you have to be at a job for like 2 years. No, what that means is you have to be able to, you have to provide all the employment positions that you have had at least within 2 years. So let's say if you've been at a job for at least 2 years, then you just put your job. But let's see if you was at a job for 1 year and then you move to another one, you've been there for another year. If you add them together, that's 2 years. And you just, each time as the more employments you've had, you just, again, you add them up. But maybe let's say if you were a student, you would just put down that you were a student for the last 4 years, which is the reason you didn't have a job. And then you were like, okay, I've been employed for 6 months. And then there's a whole bunch of other different processes that we go when reviewing that for employment. But I want to get through this video. But yeah, wanted to go ahead and throw that out there real quick.
55%. Now, what is the traditional debt to income ratio for a conventional loan?
Around 45%. 43 conservative, but around 45%.
So give me your.
So like I told you, credit or debt to incomes, again, even he went ahead and told you there's some that go up to 55%. There are others that go to 43%. I think I have a guideline here. Give me 1 minute so I can go ahead and show you. Let's see what this one is. Is this the one that I wanted to nope. Oh, actually, this is one. So this is one from a lender. Hopefully you can see it. If not, let me see. There we go. So essentially it says Manual underwrites require that a minimum FICO of 620 and then up to a 50% debt to income with compensating factors. So essentially what compensating factor is let's say if you have great or excellent credit, that can be used as a compensating factor. Or let's say if you have like a reserve, which is called a rainy day fund. So pretty much just money tucked away in case if you lose a job, you have that money, you can make your mortgage payments. If you have that can be counted as a compensating factor. So it's just things to make up your debt to income that's over their policy. So let me see, there's another one I have. Here's the one for the 55. Hopefully you guys can see it. Well, alright, so this one, the max DTI determined by the automatic underwriting system, that's what AUS stands for, not exceed 55%. So this is another lender that will go up to the 55%, just like I went ahead and explained to you guys. So again, it just varies from the lender to lender, but on the FHA guideline, it shows that the max debt to income is 50%. Give me 1 minute here. Let me show you that. I guess not. Alright, but just go ahead and believe me, I don't want to really hold up too much of this video. So yeah, so like debt to income is 50% for FHA. And yeah, let's get back into this video.
Perspective on the conventional versus a FHA type of loan product. What is the benefits? Give me a quick pro and con statement on how you feel on the difference between the FHA and the conventional and the benefits of it.
Okay, with the conventional, that you can do 3% down, you can do 5% down options, and with mortgage insurance, it goes away once the loan reaches 80% loan to value. With FHA, the mortgage insurance stays on the loan unless you put 10% down initially, and then if you put 10% down, then you pay mortgage insurance for 11 years on the loan. So that's the thing about it with the FHA. The difference is the mortgage insurance factors. You can save money over time with conventional, but if you have higher debt, then of course FHA is a good thing to get into, but you don't necessarily have to stay there.
Okay, so I did some research, and a lot of loan officers recommend.
Okay, so let's touch on that. So I'm wondering if because he said to give some quick rundowns, the difference between FHA and conventional, why he didn't give more. But there's a lot more differences when it comes to a FHA and a conventional. Like FHA, they're more lenient on credit and the requirements for you for your credit and what standing it has to be. So here's a look through the FHA guidelines. I was able to find this one right here. So if you have bad credit, this is all that they require, at least through FHA. So it says underwriter may consider a borrower who has acceptable payment history. If the borrower has made all housing and installment debts are anything like your car loan, personal loan. Let's say if you have let's say if you have a motorcycle, that's an installment debt. Personal loan. If you have a fixed secured home equity loan, that can be an installment loan also. So yeah, so housing and installment payments on time for the previous 12 months. Did you hear that? 12 months. So you could have been past due over a year ago. And they say all you gotta do is have a year of on-time payment history and all is forgiven. If that ain't easy, or I don't even know, like, wow, when I got into mortgage underwriting, I was really surprised with the FHA guidelines. I was like, so you're telling me they can be late and have multiple late and that's fine? So, but wait, there is more. So, okay, so in the previous 12 months and has no more than 2 30-day late payments. So if you have more than 2 late payments reporting on your credit from your mortgage, or also installment payments in the last 24 months, then it's an issue. So this one is a little bit more strict. So when it comes to mortgage, because again, you're getting a mortgage loan, so the last thing we want to see as underwriters that you're missing your payments for your mortgage. Like, hello, you have to be missing that stuff. So when it comes to so the difference here is, so you have to make sure that you've always made your payments on time for the last 12 months. That's the first requirement. The second requirement is you can't have missed more than 2 payments on either your mortgage loan or your installment loans, which I went ahead and went over with. So let's look at like your credit cards. So it says underwriter may approve a borrower with acceptable payment history if the borrower has no major derogatory credit on revolving charge accounts in the last 12 months. So when it comes to your credit cards, as long as you don't miss payments on those, you're okay based off these guidelines. But let's see if you do have a lot of missed payments. So it says major derogatory credit on revolving charge accounts must include any payments made more than 90 days after the due date, or 3 or more payments more than 60 days after the due date. So seeing it there, if you've missed a lot of payments, it is still all golden. So that's one thing that's different with FHA and conventional is your credit. As you can see right there, they were very lenient. The other difference that it is also with FHA, you only, if you're getting like a 2 to 4 unit home, so essentially homes that have multiple, it's multifamily pretty much, there's a rainy day fund that you need to have it. Normally through conventional it is up to 6 months. With FHA you can have up to 3 months. And again, this is why you subscribed. And if you're new, subscribe. But I'm holding it down, giving you the information that other financial gurus do not tell you when it comes to getting a mortgage. So right here is the proof. Boom. So we are right here. Let me highlight this. I guess I can't highlight this, but essentially right here. Required reserves, aka rainy day fund, for 3 to 4 unit properties. The mortgage must verify and document reserves equivalent, which means equal, to 3 months of PITI, which is pretty much payment, interest, taxes, and insurance. That's what PITI stands for. And then you have an A, which is for association, so that can be like HOA for the association. After closing for a 3 to 4 unit property. So that means when you are closing your loan, by the end, you gotta have that 3 months of that mortgage payment saved. And so let's go ahead and look at conventional. Alright, so conventional, here we go. If you're purchasing for a home, which is right here, purchasing, 2 units, 3 to 4 units. I don't think you guys can see. Let me move this up a little bit. Right here. So if you see right here, the minimum reserves, again, the rainy day fund, minimum reserves. For a 2 unit, you have to have 6 months. For it, or if you have a lower credit score, lower than 700, 12 months. You have to have a whole year of the mortgage payment saved. That is really hard to save when you're trying to save for the down payment, the closing cost, and now you have to have like almost up to about a year for mortgage payment. Now you can see how FHA is a little bit more better as opposed to conventional, and this is just through one lender. There's another lender that's a little bit more easier. This one is called Freddie Mac, and then if you only have 1 to 6 finance property, like it states right here, then let's see this. There we go. 1 to 6 finance properties included. Then you just need 2 months of the monthly payment amount as your reserve, aka rainy day fund. But if you have more than 6 properties and you have 7, then you need 8 months. And then again, here, if you're just buying like a 1-unit house that, you know, the other parts can be rented, you don't need any rainy day funds. For 2 to 4 units, you need 6 months. So that is a very distinct difference when it comes to FHA versus conventional. They have definitely different requirements. With also another difference is that the appraisal, there, whenever you're getting your home valued, which is what appraisal is, just in case for people that don't know, that is also something that's different. FHA has all these different requirements as opposed to conventional, which makes it a lot more easier. And then also for like somebody that's trying to reach out to somebody to buy, maybe not right now, but during the pandemic, anybody that had mostly an FHA loan, sellers were not wanting to finance because they know there's a lot more requirements that come through FHA than as opposed to conventional. So that's like another difference between FHA and conventional. So and then I made a chart here, I almost forgot. So those are a couple ones that I could think about off my head, and then I went ahead and created one. Let's see. No, not what I'm looking for. What's this? Not what I'm looking for either. So essentially what I'm looking for is the difference. Here it is. Wow, can't believe it took me that long. Okay. So more differences. So again, credit score requirements with conventional. 620 minimum credit score. Let me back it out a little bit. Here we go. Minimum down payments, like the guy said, 3.5 more for FHA versus conventional. Your max debt to income for FHA, if you have a low credit score, 43%. If you have above 580, 43 to 50%. But remember, I showed you a lender that had 55%. See, so it all just depends. For conventional, 36. But if you have like a 740 and above, you can go up to 45%. Other differences is the loan limits. So essentially, with FHA, they are lower as opposed to conventional. Right now, obviously, it's a lot different. Mortgage insurance is always required under FHA, even if we bring it down past 80% of the value of the home. With conventional, if you do like a 20% down, you won't have to pay the private mortgage insurance, or if you get down to 80% of the value of the home, more like 79%, then the private mortgage insurance will go away. But then maybe you're talking to yourself like, I never heard of private mortgage insurance. So that is something to know. So whenever you finance less than 20% down of the value of the home, you're required to get private mortgage insurance, which pretty much protects the loan in case if you stop paying and let the house go bad and go into foreclosure. So that's essentially what PMI will go ahead and do. But and then, like I said, the last one is property standards, stricter standards with FHA, and then flexible with conventional. So as you can see, there's quite a big difference that wasn't stated, which I wish the is it the host or the guy that's speaking, pretty much, he didn't have him do a quick rundown, because again, it doesn't justify, you know, the information that needs to be told for the difference between FHA and conventional. So there you go, my people. Let's hop back into the video.
for you to go into FHA initially just to get the process going and then refinance to conventional. Have you heard of that? That strategy. What do you think about that?
Well, a lot of times I think that strategy will work if that person has the wherewithal, the finances, and going to put enough money into that loan to pay it down enough to meet the conventional financing guidelines. So if that person is willing, if the loan officer is guiding them through that process, that's easy. But if they're not guiding them, they're just putting FHA out there just because it's an easier product, lesser, restrictive guidelines, things of that nature, then that's unfair to the borrower. So if you educate them on the process, because it's going to be a more expensive option because of mortgage insurance, things of that nature, right? So if you're not educating the borrower, then you put them at a disadvantage.
What is the criteria for?
So just touching again right back, because he touched on it again. So if you're not educating, or your loan officer is not educating, you can end up paying more, because that's the thing with FHA. You will pay more in the long term because the mortgage insurance doesn't go away. But at the same time, when it comes to FHA, the reasons why people will get an FHA is because they don't have the best credit, or maybe they're trying to get into having an investment property, and then with FHA they can do that as long as it's going to be your primary residence that you're going to live. It's a lot more easier requirement to get an FHA loan as opposed to conventional. With conventional, they require for you to put 20% down if you're going more than a one family house. So that's the reason why I see people really get FHA, because of those reasons. They're a lot more easier, and getting into investing in real estate, it's a lot more easier. The good thing is, like he says, you can always refinance once you're in a better position to have more than 20% of the equity in your home, and then convert it into a conventional, so then you can get that private mortgage insurance away. So ta-da! I'm out here clearly for guys. Hit the like button and subscribe, please. All right, let's get back to it.
FHA loan, how can you get one with a low credit score?
Well, a lower credit score FHA, they have some options out here now where you can do 500 credit score, you put 10% down. Okay, then you can do a 580 credit score, 3.5% down.
Okay,
so
that's a big difference.
That's a big difference.
So let's transition into credit, right quick, because a 500 credit score can get you in the door for a home loan, correct?
Yes.
If you have 10% down. So if you looking to buy a home loan in Detroit or Gary, Indiana, or something like that, you can get those home loans relatively like $80,000, $70,000. 10% of that is not that bad.
Yeah.
But you don't want to aim for that. You don't want to aim for a 500 credit score. And that actually, let me transition over to credit repair, guys. If you have anything on your credit report as far as derogatories, if you have any late.com, allow yourself, as you can see, actually bringing your bragging down. What is your idea? Go to mycreditapproved.com and get those items taken care of. Now, what is your ideal FHA applicant? What did that look like?
Man, my ideal FHA applicant looks like the 2 year of the history of the job, W-2 employment, or self-employed, or just steady income. Okay, we have the credit. 640 is pretty much a sweet spot that you want to kind of be at, especially with the rates rising environment that we have right now. You can get in low, but again, of course, it's going to cost you in the end, right? So have the assets there, have some reserves saved up, three to 6 months of the mortgage payment saved up, along with your monthly bills and stuff like that. So those are the ideal client that has a reserve, that has the assets, that has the credit, and then now they're not coming in looking for anything, and if anything does happen, it's just going to be extra. So have the down payment, the closing costs, just have that assets, just be in that good position, and if not in that position immediately, be willing to listen to the information and the knowledge, and then go back and execute it and go from there.
Awesome. What about student loans? Because I do know FHA is a government insured backed loan, right? So I know that student loans can be a hindrance if you go into additional government funding outside of student loans not being paid, right?
Yes.
So give me a full rundown on student loans and what is the criteria for getting approved if you have defaulted or student loans in general.
Okay, if you default on your student loan, you definitely want to get those out of default, because it's going to affect you. Even if you go through credit repair, and get some of those student loans taken off your credit, we run what they call a KRIS report, and that report is going to show any governmental debt that you have. So there's no getting away around that. So really, you've kind of wasted your money by putting that, getting that credit, probably getting those off of there because it's going to come up. Okay. Right. Now, if you have payments on it, or if you paying the minimum payment, what you want to do is that if you're doing an FHA loan, if you're making a minimum payment, what they're going to calculate is 0.5% of the balance of that student loan, or the payments that you're making, whichever one is greater. That's the one they're going to use as far as the payment. Okay. Say if you don't have anything set up, nothing established, no kind of payment plan, nothing like that, say it's deferred. Okay. Not in default, but just deferred to where you're not making any payments, then we count 0.5% of that balance, charge your debt to income ratio. So that's how those student loans are calculated. But if they're in default, as we said in the beginning, definitely get those out of default, because you can't get an FHA loan with student loans in default, because how the underwriting, how the government looks at it, they're going to come after you after that, and then your assets, home, will be in trouble because of that debt. So they want you to be in a good situation.
So guys, there is no wrap around or get around from the student loans if you are going into this particular line of funding. Is conventional have the same stringent guidelines when it comes to student loans?
With conventional with student loans is that if you have on an income-based repayment plan with student loans, if that payment shows 0 on a conventional loan, we show 0 as your monthly payment. But if you don't have anything set up as far as they're in deferment, if you will, 1% of that balance is counted in the conventional case versus the 0.5% with FHA.
Right. So guys, you want to make sure that the student loans is taken care of. There is no get around, no get quick way of getting around the student loans. You want to make sure that you actually get those taken care of before going to the pre-approval process. Okay. Yes. What about self-employed? Self-employed individuals that want to go into the FHA. I know we talked about self-employed last time, but we didn't talk about FHA particularly. Who can get approved that's actually self-employed going into FHA funding?
The 2-year person that's self-employed that doesn't write off a lot on the taxes, that'll be the ideal one to go into, because they use that available income, your adjusted gross income. That's what they use. And so if you have a nice amount of that left and they can balance that out, that makes it an ideal candidate for the FHA, because they could just go by your returns versus having to do the bank statement option, because that's a non-QM program to where Fannie and Freddie can't sell those loans, or Ginnie Mae in the case. So
what's the difference between a 580 and a...
All right, we haven't had a pause for a while. Means that they're doing something right. So, all right. So the reason why I paused it is for the self-employment income. Okay, so people that are self-employed that do a Schedule C income. So there's four type of ways of people that are self-employed. You have people that when they do their tax return, Schedule C, that a line 31 is used, which I will show you here right now. Bam. It's going to be a little blurry, but I'm going to try to do my best to show you. So you have a line 31 right here. Let me see. Let me get a little bit closer. There we go. So net profit or loss. So line 31, which goes to over here. This one says 100,000. This will be, first part that will be used for income. This 100,310. So this is what's going to be counted as your annual income that you made for the year. And then you have write-offs like right here, line 12 and 13 that underwriters will use. For depreciation is this one right here. You can't really read it well, but that's what it says. And then depletion, we'll go ahead and give you back that as money. So if this person had $5,000 written right here on line 12, we would go ahead and add it and do 100,310 plus the 5,000. So we give that back to you. And then we have use of your home, line 30. We'll give you back. Whoa, hello, my bad. Line 30, if you use your use of a home, we'll give that back to you. And then if you write off your car, that is also something that that we will go ahead and give back to you. And then the next one that is the next one is a 1120 S Corp partnership. So essentially, these are for the people that have a loan structured through 1120S, like it is right over here. So if you pay yourself like this as a self-employment, we can use line 1, but there's additional requirements that you need to go through. And we will use line 16. Normally if it says the letter D right here, that means distribution. So how much money you paid yourself for that year, we'll go ahead and use for income. And then, so that's something, if you get paid like that, you will go ahead and that's how we'll use the income for that. And the next one is, let's see if you have a partnership. Well, if you have a partnership, then your documents look like this, a 1065K1. And again, we can use line 1, and then we can use guaranteed total payment. So 4C, not to be mistaken for 4B, is 4C, total guaranteed payment. So this is like a guarantee that you're going to get paid each year. So we can use line 1, 4C, and then we're going to use line 19, which is the same like 16, it's just numbered different. And also, instead of a D, it has to be an A in here for us to use it as actual cash. So any number that's in here, that's how you get paid. And then the next one is a corporation, which I'll save that for another video. It's a little bit a lot more complicated, but those are the 4. So you have that Schedule C, 1120S partnership, and then you have a 1060 or 1120 is the S corp, the 1065 is the partnership. So if you get your income through those ways, that's how we'll gather your income of how much you made for the year, which also wasn't touched on this video, but I went ahead and touched on it. So let's hop back into this video.
640. Oh, the difference is between the loan level price adjustments, because each rate, each credit score have loan level price adjustments, and those adjustments are higher the lower the credit score is. So the lower the credit score, the adjustments are higher. Like just say, for example, if the credit score is 580 to 620, whatever the range, then the adjustment would be 1.25. Just say if the credit score is now 640, 620 to 640 now, that adjustment may be 1. You see what I mean, though? So now those adjustments start coming off of your pricing on the back end, because every rates, if I can bore you with a second, every rates, what happens that they come with a credit, they come with a cost, or they come with they come with nothing at all. And so those adjustments come off of that rate. You see what I mean? Off of those credits, the pricing that comes off the end. Right. So you want those adjustments to be as less as possible. Thus, come in with the highest credit score as possible. So 500 is available, but will it be the best option for you in the long run?
So basically what he's saying is, in order to get the highest potential of what you have available to you, you have to have the highest potential credit profile possible. The highest potential credit profile that you bring to the table, the best adjustment rate that you will actually get from the back end. Now you can get an approval, but it's the difference between getting approval and getting the highest potential approval that you can possibly get. So guys, like I said, go over to mycreditapproval.com if you have any derived.
I don't know why he phrased it like that, highest potential. I'll simplify it. So essentially, the lower your credit score, the higher the interest rate. The higher the credit score, the lower market interest rate that you'll get. And again, you're thinking about, you may be thinking, market interest rate, what's that? So market interest rate is just pretty much what they are offering a interest rate for people that have excellent credit score. So watch, I'll show you right now interest rates for a mortgage. So NerdWallet, let's see if they have something here. So essentially, yes. So let's do this. Never mind. PennyMac. Let's see. I'm not looking for any type of loan. Okay, perfect. Alright, so we're going to use this right here for now. So essentially, if you have excellent if you have excellent credit and you do a 30-year mortgage, the interest rate starts at 6.48. That is what you will go ahead and get. And then obviously, depending on the type of mortgage rates that you get, will determine. So in order to get these credit scores, you have to have excellent credit. Once you start getting into having bad credit, there will be an adjustment. They'll add to the interest rate. So if you have like a 500 credit score, maybe they'll add 2% to the credit score. So then it's 8.48 of the interest rate that you will get. So that's what he's talking about. So the better the credit score, the better the interest rate that you can get of what is being offered at that moment. So voila. Don't know why it was that complicated, but they made it. I made it simpler. But if you don't understand, then I failed my job. A comment below, and I'll try to address it in a different way for you. And then like and subscribe. Let's get back into it.
Derogatories to get those items actually taken care of. What about mortgage insurance?
Okay,
and then we'll wrap it up on mortgage insurance. We'll do a quick overview, and then we'll wrap it up on mortgage insurance. What about mortgage insurance for FHA?
Mortgage insurance for FHA is 1.75% initially down of the sales price of the home, the value, and then also you have to pay a 0.85% mortgage insurance factor that's calculated into your monthly mortgage payment. Every monthly mortgage payment consists of principal, interest, taxes, insurance, and HOAs. So that's going to be a factor into your mortgage, and so that's going to affect definitely your monthly mortgage payment and out of pocket. If you put down the 10% or so, 10% initially, then that factor is 0.80 rather than the 0.85. So it goes down a little bit, and mortgage insurance is paid for 11 years in that case versus for the life of the loan. If you put 3.5% down, then you have to pay mortgage insurance for the life of the loan unless you refinance into a conventional product.
All right, so let's do a quick overview. We have credit. The credit needs to be.
So let me show you what that looks like when caliber. So essentially, this is how a mortgage payment would look for an FHA. Again, FHA right here. So you know we're on it. Here's some key features. We're going to do an analysis. So let's see if you were getting a $300,000 house. Let me zoom in. Hopefully it'll show it better. A $300,000 house. You put 20% down. Let's make this 3.5%. Adjust. That would be $10,500. This is how much your loan amount is. Let's do that 6.85%. Make it a little bit more realistic. Blah blah blah. All right, so right here's the private mortgage insurance right here. Ooh, hello. What? Oh, there it is. All right, so this is what your payment would be: $2,521.56 based off of that interest rate. Again, interest rates will change, but this is just purchasing a house for $300,000 and putting a small down payment of 3.5%. So this is what he's referring to. So you have your principal and interest, like I talked to you about on the ability to repay, that this is just counting the mortgage loan payment only, and then this is how much you'll pay for your taxes per year, insurance, which is again is the mortgage obligation. So, and then you have your private mortgage insurance for not putting 20% down. Essentially, look at it as pretty much a tax on you because you didn't put that 20% down, and that's what will make your mortgage payment. Voila! So this one's showing $241 to do this one. Let's look at conventional. All right, let's see here. Conventional, home ready, home one, conventional, and here it is. So now we're going to see the difference in between conventional and FHA. 300,000, we're going to do 3.5%, which again is at 10,500. And look at the difference in between. Oh, well, the interest rate. I forgot. JK, I'm a liar. Let's go. So the payments are roughly the same, but again, you'll only have this for until you bring that value down. So again, you're looking at the same payments with that, but I just wanted to give you a little bit more of a better clarity when it came to what your mortgage payment will look like based off the certain loan amounts. So the lower the credit score, the higher the credit score, the closer you'll have to a better interest rate. But if you would switch that and do the 8.85, like I told you before, for having bad credit, you're at $2,521. Bam! You see how that almost jumped $400 for just having bad credit. Now you're almost at a $3,000 payment. So it pays to have really, really good credit. So let's hop back into this video though.
At the 500 minimum, but at 500 minimum, you're going to get a range of a 10% down payment option. 580 gives you a 3.5% down payment option, and anything above that is going to give you a better potential adjustment rate going forward. Correct?
Yes, sir.
All right. So, and then we talk about the DTI. The DTI is very important, guys. Now, the DTI is your debt to income ratio, which is basically how much you're actually spending versus how much you're actually bringing in, right? So you don't want to go out and buy a new furniture before you get the property. You don't want to go out and get new vehicles to pull up in the new property. You want to make sure that your credit profile is looking like your expenses is as minimum as possible before you actually go into the position into the pre-approval process, because the less expenses that you have and the more income that you can get, the more affordability that you can afford on the loan. Am I correct?
Ability to repay.
Ability to repay.
Sorry, you just said it. Kind of with a swallow that water. Ability to repay.
I just want to make sure I'm getting the people, give my audience what it is.
Yes, I definitely.
And again, touch it back on that debt to income DTI. Again, remember, this goes based off what is on your credit, not what your other expenses are, like groceries, maybe your Netflix subscription or other streaming subscriptions that doesn't get counted. But you always want to keep those as minimum as possible, because again, you want more money in your pocket. And then once you get a mortgage loan, like you saw, if you've been used to paying $1,500 or $1,800 a month, now that's gonna skyrocket if you don't do 20% down at least. So again, your debt to income, and again, we went over what they require. You want to make sure that it is low as possible, that you can get it. So we're almost done here. Bear with me. It's almost over.
Okay,
definitely appreciate
that. No, absolutely. And then we're going to talk about the work history, right? The work history is above 2 years or more, and we want to make sure that you are actually bringing to the table matches your employment history. Now, when I say employment history, I don't mean working, getting cash. I'm not talking about that. I'm talking about actually having history on the books and making sure that you're actually having a W-2 type income.
Yeah,
right?
And also too, though, let me elaborate on that a little bit. In the income, because we need 2 years. That's not necessarily 2 years at the same company, just 2 years of the same type of employment.
Oh, that's a good nugget, guys.
Yes.
So you heard that? I said that. I know what I'm talking about. If you're new to my channel, look at that. He's saying the same thing that I said. Stop playing with your boy, man. Subscribe. Let's go.
You can have multiple employers, but you just want to make sure that you have 2 years steady income coming in where there's no lapses.
In that field.
Right, in that field. And if the lapses happen, then that's when you want to call.
Letter of explanation.
That's when you want to call the loan officer who cares, tell him your situation, and then he'll actually finagle it for you, put it and push it through. Now I'm just playing. But you just
we will look at the numbers and we will see what they show. We will definitely see what they show.
We'll make sure that your story match the outline of what you're saying. But
yes, we do what we can.
Yeah, but absolutely. So those are the basic guidelines for getting approved. Now the FHA, like I said, now is there any zone requirements for getting approved for FHA? Can you get a new build with an FHA loan?
Yeah, you can get a new build and everything. It's just the loan amount is going to be different based upon the county. So a different county limits and stuff. So based upon the county, zip code, things of that nature would determine the maximum FHA limit.
What is the max FHA loan you can get?
Like 4 something, 5 something, 6 something. Just all depends on the county. You know,
you can get a jumbo loan with the FHA.
Not necessarily you can get jumbo. They stop at a certain amount. They stop at a certain amount to where they don't want them to be jumbo, so they have like certain limits, whatever that they max them out. But they can get up in the 6 and the 7s, just depending upon the county that you are, can still fall up under that FHA conforming limit guidelines.
Oh wow!
Yeah,
all right, guys. Guys, if you
area.
found any of this information helpful, if you found any of these meat potatoes.
All right, so the last thing we're going to touch on is going to be the FHA loan limit. So I think they were in Texas, loan limits in Texas. So as you can tell, there are certain limits that FHA will go ahead and go through, and I have it here pulled up again, depending on what county you live. I'm not really too familiar with Texas, but essentially these are the loan limits. So FHFA, they are the government entity that establishes the loans, the max that you can get a conventional loan or just a mortgage loan in general before it becomes a jumbo loan, which normally you see jumbo loans through people that normally get like $1 million houses. Those are occasionally the people, sometimes you'll get the people that are over the conventional conforming limits, and then they'll qualify as a jumbo as it's stated on the FHA limit. So that's essentially is the cap, and then as you can see, FHA will only go up to $472,030 in Anderson County, wherever that is, whatever cities are revolving around that. That's essentially the max that you can get with the FHA. And again, this may be outdated. What is this? 2023. Yep, actually, this is the most accurate. There you go. FHA limits. Bam. There you go. That's the max that you can get in this county. And all you got to do is just Google pretty much FHA conforming loan limits in your state, and then put your state. And then it will go ahead and pull up those loan limits. You find them, and then there you go. But there you have it. This video to me was, it could have been a lot better. I definitely don't blame the mortgage loan officer. I blame the person asking the questions. You could tell that like he didn't have too much confidence in like the information that he was saying. But so this is what I mean. I would have asked, okay, what are reserves? Can you break down what a reserve is? Because a lot of people don't know that term. That's only something in the mortgage industry that is known. That would have been like, okay, what's the reserve? Okay, what's the minimum requirement for a reserve? Okay. Income. I would have gone a little bit more into income. I would have been like, okay, how does it work for overtime income? What is the guidelines for that? Because the thing is, he has access to guidelines. Like I have access to guidelines, and you were able to see a little bit about the debt to income. Those are just guidelines that I have. So I was like, I wish he would have asked a lot better questions and better prepared. But overall, video was good for what it was. So, but let's go ahead and hop into this next video though. All right, let's go ahead and hop into these videos right here. These are gonna be the last couple ones that we're gonna do, and then we'll go ahead and wrap it up from there. So just a couple shorts that I found that I want to go ahead and address. So let's hop into these. All right, so let's see. 3 things to know.
All right, three
things to know when applying for loans. Let's see if she hits it on the head.
things to know when applying for personal credit and personal funding. All right. So number 1, you must know your credit score, and don't leave because I know nobody wants to talk about credit, but we must. All right. So if you want the personal loans that are 3 to 0% interest, you want to have a 700 credit score or better. And some programs do allow you to get a cosigner. All right. So join my credit workshop that is coming up, and it's absolutely free. All right. So the second thing you want if you are applying for personal funding and personal loans is you want a plan. All right. You want to have a plan for what to do with this funding when you get it, like a plan that will help you to generate more money and a regular income. All right. The third thing you want to know is how to get to my website and click those links in my bio.
No, we're not doing that. Okay, so I don't know if this is misleading. I was like, I guess that's three things you can know. But normally, when people are wanting to, three things to know when applying for a loan, the great thing to know is credit. What are the requirements for credit? What is the minimum credit score? Can you have bad credit? If you're currently past due, will you get the loan? Obviously, that's a no. But again, these are things that they need to go ahead and talk about. Debt to income, that's another important factor. What is the limit that they're willing to give you based off your debt to income ratio? That's something else. And then third, to get to her page, really? Like, you only gave one good advice as opposed to giving the last two good advice. I would have threw that in as a secret tip, but essentially, a third advice that you would want to know is credit experience. How much is it that you're applying for? If you never had anything close to, let's say, $20,000, don't expect to be approved for a $20,000 loan. Like, you gotta have experience to get approved for certain loan tiers. Like, you have to work your way up. So if you've only had 5,000, let's push your limit now to 7,000. Make good payment history, pay that bad boy off, and then jump to 10. And you just slowly start making your jumps in order to get you up to the loan amount that you're wanting to. That is something to go ahead and know. Let me see. Something else to go ahead and know, what other requirements, like with personal loans. When I worked at a bank, sometimes you need to provide liquid assets. What are liquid assets? Liquid assets are pretty much like cash in banks. If you have stocks, bonds, 401k, those type of things. If you have cash value from life insurance policy, that can be counted as assets. So it's like, those are like the requirements when it comes to applying for a loan that she could have touched on. And also, those were just a couple that I went ahead and provided. So I don't know, that was a very bad for that video. All right, let's hop into this next one. How to qualify for a personal loan with bad credit. Here we go, another one.
So qualifying for a loan with bad credit might be difficult. However, you still have some options if you're willing to put in a little work. So many online lenders, credit unions, as well as banks offers personal loans to individuals with bad personal credit. However, online lenders tend to be a more convenient choice for most individuals. It is safe to say that if you already have an account with a credit union, you could avoid a lot of high interest rates as well as other fees as compared to other options. And when you're ready to apply for these loans, in order to have a smoother application process, you must come prepared with the appropriate documents like your identification, proof of income, proof of address, and etc. Keep in mind though, the easiest way to get approved for a personal loan with bad credit is if you have a co-signer or if you apply for a secured loan if you have some type of collateral. So qualifying for a
this sounds like information that you may have seen in other videos. Like, this is not, those are like minimal, like identification. I wouldn't say it's gonna be like, it's not gonna, it's, if you don't have an ID or identification, it can break the loan for you getting a loan. But if I had to list it like how important it is, because it is still important, it's not really in the spectrum the highest. He mentioned proof of income. If you're gonna state that you make certain incomes, there are online lenders that will require for you to provide pay stubs. That is a requirement when it comes to getting these loans. Another one I would say, okay, what's the minimum credit score? Like in the video before, it was the minimum credit score. If I have bad credit, how long do I need to have been having great credit to get approved? Because that is something to know, that if you have bad payment history, that can go ahead and affect you from getting a loan. But again, those type of lenders know that those people will have bad credit, so it's like they're looking now for positive stuff when it comes to getting a loan. So it's like, okay, how long have you been now making your payments on time, or have you already been caught up on your loans? Another one is, what is the credit experience that you have? That is also something that's very important. I may be repeating myself, but this is stuff that is from lender to lender. Like there's a lot of things that they all have in common, and that is something that is one of them is like a credit experience. How much are you applying for? And tackling his is if you have a cosigner in a secured loan, you can have a cosigner in a secured loan and you still can get turned down. Like maybe the cosigner doesn't have the best credit themselves, which is something he should have said. Like, well, get yourself that has somebody a great to excellent credit score that will increase your chances of being approved. But only because they have positive credit doesn't mean that's gonna compensate for you having bad credit. Like if you have bad credit and you've missed a bunch of payments here in the last 6 months, that can be a real issue. And the same thing with secured loan. Only because you have collateral to back up the loan doesn't mean that you'll get approved. That'll secure the loan and bring it less risky, but it doesn't remove the main factor. The main factor when it comes to giving you a loan is going to be your credit. That is like one of the top information that is valuable, because that's the way that we determine risk. And then also your debt to income ratio. So this guy did not hit this right. I was just like, really? This is the best you got? Like no guidelines at all, like, you know, like me. So it's like, this is wild. So yeah. Alright, let's hop back into this last video.
Hi, can you help me buy a house? Sure, how much are you trying to spend? I'm not sure, but I heard that I can buy a house with just 3.5% down with an FHA loan. How? What was that for? I'm sorry, I had to slap you back into reality. The truth is, an FHA loan is a lot harder to qualify for, and they have a lot more requirements. And the real estate market is just so hot right now that many sellers will automatically discard an offer that has an FHA loan attached to it. Then what should I do instead? You can still buy a home with a conventional loan with just 5% down. Good idea. I wish you didn't slap me though. Then you should learn more by following Sean. He makes real estate easy. Hi.
Well, Sean, you got a lot to go. What was that? Remember, we just watched a loan on FHA, and I read you the guidelines through FHA. Like, that... I don't even need to speak for that, but if you're new to the channel, with FHA it's actually easier to get approved for a mortgage as opposed to conventional. And then I don't know why you would want to put 5% down when you could put 3.5% with FHA. This was just bad advice all over. When it comes to get a loan, this is what it happens when you need to be educated when you're teaching people. So yeah, with FHA, you don't need to have the best credit. You need to be at least reestablished within the last 12 months. So if you have a mortgage payment, then no missed payments. No missed payments. You can't have missed more than 2 payments on your mortgage within the last 12 months. And then your other installment debt. And then honestly, if you miss payments on your revolving accounts like credit cards, as long as you've repaid back on those loans, and you're no longer within those delinquency days, yeah, you can get an FHA loan. And then a low requirement, you can do lower than 3.5 if you get a conventional, like it was talking in the video, and you can do 5%, but it's not like the minimum. The minimum is actually 3% to get a mortgage. So it's like, I don't know why he would say what he said, but well, there you have it. If you're new to my channel, subscribe. Make sure you hit the ring notification for more videos, and I'll see you guys on the next one.